Something unprecedented is unfolding in the silver market right now. 25 million ounces have disappeared from the physical supply chain in a matter of weeks. At the same time, one of the largest short positions in modern precious metals history is quietly unwinding. This isn't speculation. This isn't rumor. These are verifiable movements happening in real time across global exchanges and vaults. For those who understand market structure, this combination sends a clear signal. When physical metal vanishes, while short sellers scramble to exit their positions, we're witnessing the kind of supply-demand imbalance that can reshape an entire market. Today, we're going to examine exactly what's happening, why it matters, and what it means for your financial strategy going forward. Whether you currently hold silver or you're considering your first position, the decisions you make in the coming months will be shaped by the forces we discussed today. This is a moment that demands clarity, not emotion. Strategy, not speculation. Let's begin. First, let's establish the facts without hyperbole. Physical silver inventories across major depositories have declined by approximately 25 million ounces in recent weeks. These aren't theoretical claims. These are registered drawdowns from trackable vaults, including COMEX warehouses and major ETF holdings. Simultaneously, data from the Commitment of Traders reports shows a significant reduction in commercial short positions. These commercial shorts, typically held by banks and large institutions, represent contractual obligations to deliver silver at specified prices. When these positions unwind rapidly, it indicates one of two things. Either the shorts are taking profits, or they're cutting losses to avoid delivery obligations they can't fulfill. The timing is critical. Physical withdrawals and short covering happening simultaneously creates what market technicians call a squeeze dynamic. Understanding market structure requires looking beyond simple supply and demand. Silver exists in two parallel markets: the physical market where actual metal changes hands, and the paper market where contracts and derivatives dominate. For decades, the paper market has dwarfed the physical market by orders of magnitude. Some estimates suggest that for every ounce of physical silver, there are between 100 and 300 ounces of paper claims. This works fine during normal market conditions. Most contract holders never demand physical delivery. They settle in cash. But when a significant number of market participants suddenly want actual metal, not paper promises, the entire structure becomes unstable. Think of it like a bank run, but for commodities. The contracts are valid. The obligations are real. But if everyone shows up at once demanding their silver, there simply isn't enough physical metal to satisfy every claim. This isn't the first time we've seen this dynamic play out. In 1980, the Hunt brothers attempted to corner the silver market. Prices exploded from $11 to over $50 per ounce in a matter of months. That situation ended badly for the Hunt brothers, but it demonstrated something important. The physical silver market is far smaller and more liquid than most investors realize. More recently, in early 2021, retail investors coordinated buying pressure on silver, inspired by the GameStop stock phenomenon. Physical premiums spiked. Dealers sold out of inventory. Delivery times stretched from days to months. The price rose, but not as dramatically as many expected. Why? Because the paper market absorbed much of the buying pressure without requiring physical delivery. But here's what's different about the current situation. This isn't driven by retail speculation or a coordinated social media campaign. This is institutional repositioning. This is commercial shorts, the very entities that have historically suppressed price rallies choosing to exit their positions. When the players who normally provide market stability start heading for the exits, you need to pay attention. No market exists in isolation. Silver's current dynamics are unfolding against a specific economic environment. Global debt levels have reached historic proportions. The United States alone carries over $34 trillion in federal debt. Central banks worldwide have printed unprecedented amounts of currency over the past 15 years. Interest rates, after a rapid hiking cycle, remain uncertain as inflation persists above target levels in most developed economies. Geopolitical tensions have escalated. Supply chains remain fragile. Energy costs fluctuate dramatically. In this environment, hard assets gain appeal, not because of speculation, but because of fundamental concerns about currency stability and systemic risk. Silver occupies a unique position. It's both a monetary metal and an industrial commodity. Unlike gold, which is primarily a store of value, silver has critical applications in solar panels, electronics, electric vehicles, and medical equipment. Demand from these sectors has grown steadily while mining production has remained relatively flat. Meanwhile, above-ground stockpiles have been drawn down consistently. The surplus inventories that existed 20 years ago have largely disappeared. Market movements aren't just about numbers on a chart. They're about human behavior under uncertainty. Right now, several groups are operating with conflicting objectives. Industrial users need physical silver for manufacturing. They can't afford supply disruptions. Investment funds are reassessing their commodity allocations as inflation expectations shift. Commercial banks that held short positions are evaluating their risk exposure as physical tightness increases. Retail investors, burned by previous false rallies, remain skeptical but curious. Each group responds to different incentives. Each has different time horizons and risk tolerances. This creates volatility, not random volatility, but the kind that emerges when long-held market structures begin to shift. Let's ground this discussion in concrete information. COMEX registered silver inventories, which represent metal available for immediate delivery, have declined substantially. ETF holdings, particularly in physically backed funds like SLV, show net outflows in some periods, but strong physical demand in others. Premiums for physical silver coins and bars remain elevated above spot prices, indicating retail demand outpaces retail supply. Delivery times from major dealers have extended, suggesting wholesalers are working with thinner inventories than normal. None of these indicators alone would signal a major shift. Together, they paint a picture of a market under stress. The modern silver market is heavily influenced by derivative instruments. Futures contracts, options, and various structured products allow participants to gain exposure to silver price movements without holding physical metal. This creates leverage, and leverage amplifies both gains and losses. When prices move against leverage positions, participants face margin calls. They must either add capital or close positions. If many leverage players are forced to close positions simultaneously, it creates cascading movements. We've seen this pattern before in other markets, sudden, sharp moves that seem disproportionate to the underlying news. The current short position unwind suggests that leveraged players are reducing risk, possibly anticipating further price appreciation, or simply unable to maintain their positions as physical demand tightens. While investors focus on price charts and trading patterns, industrial demand continues its steady climb. Solar panel production requires significant silver content. As renewable energy deployment accelerates globally, this demand component grows. Electric vehicles use substantially more silver than traditional combustion engine cars. The global electronics industry depends on silver for its unique conductive properties. Medical applications, from wound dressings to diagnostic equipment, consume silver consistently. This industrial consumption doesn't fluctuate with investor sentiment. It represents baseline demand that must be met regardless of price. When investment demand surges on top of steady industrial consumption, the available supply shrinks rapidly. Mining production doesn't respond quickly to price signals. Bringing a new silver mine online takes years of exploration, permitting, and development. Most silver comes as a byproduct of copper, lead, and zinc mining. Pure silver mines are relatively rare. This means silver supply is largely determined by the economics of base metal mining, not silver prices alone. Recycling provides some supply, but it's limited. Unlike gold, much industrial silver is consumed in applications where recovery is impractical or impossible. The result is a relatively inelastic supply curve meeting increasingly inelastic demand. Markets tend toward equilibrium, but the path to equilibrium can be volatile. If physical demand genuinely exceeds available supply at current prices, prices must rise until demand is rationed or new supply emerges. The question isn't whether equilibrium will be reached. It always is, eventually. The question is how much volatility occurs during the adjustment process, and who positions themselves appropriately beforehand. Financial media thrives on dramatic narratives. Silver to the moon! Headlines generate clicks. Our job here is different. We're seeking to understand the underlying mechanics, not to feed emotional reactions. Yes, 25 million ounces is a significant amount of physical metal to leave the system. Yes, major short covering suggests institutional players are reassessing their positions, but these facts don't guarantee any specific outcome. They indicate heightened probability of volatility and potentially sustained price appreciation if current trends continue. Markets can remain irrational longer than you can remain solvent, as the saying goes. What matters is understanding the probabilities, the risks, and the appropriate strategic responses. If you already own physical silver or silver-related investments, your strategic priorities differ from those considering entry. First, avoid the temptation to trade around your position based on short-term volatility. One of the primary mistakes precious metals investors make is selling too early during the beginning of a sustained move. They see a 20 or 30% gain and immediately take profits, only to watch prices double or triple from their exit point. This doesn't mean you should never take profits. It means your exit strategy should be based on your original investment thesis, not emotional reactions to price movements. Ask yourself, why did you initially purchase silver? If your reasoning was protection against currency debasement, has that risk disappeared? No, it's arguably increased. If your reasoning was industrial demand growth, has that trajectory changed? No, it continues upward. If your reasoning was portfolio diversification, does your portfolio still need that diversification? Most likely, yes. If silver represents more than 20% of your liquid net worth, you may want to consider rebalancing. Concentration can produce spectacular gains, but it also creates vulnerability to sector-specific shocks. A balanced approach might involve taking some profits if your silver holdings have appreciated substantially, not to exit the position entirely, but to return to your target allocation. This is portfolio management, not market timing. You're not predicting the top. You're maintaining discipline around risk exposure. Conversely, if silver remains a small percentage of your holdings and your conviction in the thesis remains strong, there's no compelling reason to sell into the current volatility. Physical silver holders should review their storage arrangements. If you hold significant quantities at home, have you considered the security implications? If you use third-party storage, do you understand the terms? Is your metal segregated or pooled? What are the redemption procedures? These aren't theoretical concerns. During periods of market stress, operational issues can emerge at storage facilities or dealers. Ensure you have proper insurance coverage. Ensure you have documentation of your holdings. If you hold silver through ETFs or similar vehicles, understand the fund's structure. Does it hold physical metal? Can shares be redeemed for physical delivery? What are the associated costs? If you don't currently hold silver and you're evaluating whether to establish a position, your considerations are different. The worst possible approach is to dive in impulsively because of headlines about vanishing inventory and collapsing short positions. Fear of missing out is one of the most destructive emotions in investing. Instead, begin with fundamental questions. What role would silver play in your overall portfolio? Are you seeking a hedge against monetary instability? Are you making a bet on industrial demand growth? Are you diversifying away from traditional equities and bonds? Your answer determines how much exposure makes sense and what form that exposure should take. If you decide silver warrants a position in your portfolio, consider a scaled entry approach. Rather than deploying your full intended allocation immediately, divide it into 3 or 4 tranches. Make your first purchase now to establish your position and begin learning the market's behavior. Plan additional purchases at predetermined intervals or price levels. This accomplishes several things. It removes the pressure of timing a perfect entry. You're averaging into the position over time. It keeps you engaged with the market without being overexposed to short-term volatility. It preserves capital for opportunities if prices pull back temporarily. Markets rarely move in straight lines. Even during sustained bull markets, corrections of 10 to 20% occur regularly. A scaled entry strategy positions you to benefit from this volatility rather than being paralyzed by it. New investors face a fundamental choice: physical metal or paper claims. Physical silver means coins, bars, or rounds held personally or in secure storage. The advantages are clear: true ownership, no counterparty risk, immediate access. The disadvantages include storage costs, insurance considerations, larger bid-ask spreads, and potential liquidity constraints if you need to sell quickly. Paper silver includes ETFs, mining stocks, futures contracts, and various structured products. The advantages include liquidity, ease of trading, no storage concerns, and in some cases, leverage. The disadvantages center on counterparty risk, management fees, tracking error, and the fact that you don't actually own physical metal. For most investors, a hybrid approach makes sense. A core position in physical metal provides the security and peace of mind of true ownership. A supplementary position in liquid instruments like ETFs provides flexibility for tactical adjustments or easier profit-taking. Silver mining stocks offer leveraged exposure to silver prices. When silver prices rise, mining company profits typically rise faster because their costs remain relatively fixed. This can produce outsized gains during precious metals bull markets. But mining stocks come with risks that physical silver doesn't carry. Operational issues at mines, management quality, political risk in mining jurisdictions, currency fluctuations, labor disputes, environmental regulations. A mining company can go bankrupt even as silver prices rise if they operate inefficiently or face site-specific problems. If you choose mining stock exposure, diversify across multiple companies. Don't bet your entire allocation on a single operation. Research the company's production costs, reserve life, jurisdiction, and management track record. Treat mining stocks as the highest risk, highest potential reward component of your silver strategy. Some investors consider using options or futures to gain silver exposure. These instruments can provide significant leverage, allowing control of large amounts of silver with relatively little capital. They can also produce total losses very quickly. Unless you have substantial experience with derivatives and a clear understanding of time decay, implied volatility, and contract specifications, avoid these instruments. The complexity and risk far exceed what most investors are equipped to handle. If you do use derivatives, limit your exposure to capital you can afford to lose entirely, and have a detailed plan for managing the position. Different silver investments have different tax treatments depending on your jurisdiction. In the United States, physical precious metals are typically taxed as collectibles, with higher long-term capital gains rates than stocks or bonds. ETFs may be structured differently, with some offering more favorable tax treatment. Mining stocks are generally taxed like any other equity investment. Consult with a qualified tax professional before making significant allocations. Tax efficiency shouldn't drive your strategy, but it should inform your implementation. Whether you're a current holder or a potential new investor, your level of conviction matters more than your entry or exit timing. If you don't truly understand why you own silver, you'll sell at the first sign of volatility. If you don't believe in the fundamental thesis, you'll exit prematurely during consolidations and miss the major moves. Spend time understanding the monetary dynamics, the industrial demand picture, the supply constraints, and the historical behavior of precious metals during different economic regimes. This isn't about becoming a silver expert. It's about having enough knowledge to maintain discipline when markets become chaotic. Consider your potential liquidity needs over your investment time horizon. If you might need to access these funds within the next year or two, silver may not be appropriate. Precious metals are best suited for capital. You can leave invested for extended periods, riding through volatility without forced liquidation. If you do need to maintain some liquidity, keep those funds in more stable, accessible vehicles. Don't put your emergency fund into silver no matter how compelling the opportunity appears. For both current holders and new investors, establish a rebalancing framework. Decide in advance what percentage of your portfolio you want in silver. Commit to rebalancing back to that target when allocations drift significantly. If silver appreciates substantially and grows from 5% to 15% of your portfolio, rebalancing would involve taking some profits. If silver declines and shrinks from 5% to 2%, rebalancing would involve adding to your position. This mechanical approach removes emotion from the equation and forces you to buy low and sell high, the opposite of what most investors do instinctively. The single most destructive mistake investors make in precious metals is using excessive leverage. The temptation is understandable. If you believe silver will double, why not use leverage to potentially quadruple your returns? Because volatility will destroy you first. Silver can easily decline 20 or 30% during a multi-year bull market. If you're leveraged 2 or 3 to 1, those declines will wipe you out before the ultimate appreciation occurs. You'll be forced to sell at the worst possible moment, crystallizing losses during temporary setbacks. Never invest with borrowed money. Never use margin to increase your precious metals exposure. Your position size should allow you to sleep comfortably at night, even during 40% drawdowns. Precious metals markets are volatile. Accept this reality before you invest. If you panic and sell every time prices drop 10%, you'll never capture the long-term appreciation these assets can provide. Market volatility is the price you pay for the potential returns. If you cannot psychologically handle watching your investment decline by 30 or 40% temporarily, reduce your position size until you can. Better to own a smaller position you can hold through volatility than a larger position you'll panic out of at the bottom. When silver jumps $5 in a week, the worst possible time to buy is the day after the move. Yet this is exactly when most novice investors pile in, driven by fear of missing out. The only exception is if you're implementing a long-term dollar cost averaging strategy where you invest the same amount monthly regardless of price. Some investors become so convinced of precious metals' potential that they abandon portfolio diversification entirely. No single asset class performs well in all environments. The exact allocation depends on your age, risk tolerance, and financial goals, but complete concentration in any single sector is speculation, not investing. The precious metals space attracts both serious analysts and outright charlatans. YouTube channels promising imminent price explosions. Newsletter writers guaranteeing 10,000% returns. Forums filled with conspiracy theories and misinformation. Verify information from multiple credible sources before acting on it. Anecdotal stories from anonymous internet personalities should not. Keeping substantial quantities of silver at home makes you a target for theft. Using uninsured storage or questionable vault facilities creates counterparty risk that defeats the purpose of owning physical metal. Take these concerns seriously. Plan appropriately. Don't create vulnerabilities in pursuit of returns. Some dealers push collectible coins with enormous premiums over the actual silver content. They market these as superior investments due to rarity, condition, or historical significance. You're not a numismatic expert. You cannot reliably assess the true collectible value. Stick with recognized bullion products, government-minted coins, or reputable private mint bars. Pay reasonable premiums over spot price, not 50 or 100% markups for supposed collectible value. Silver is not going to make you wealthy overnight, even in the most optimistic scenarios. Precious metals? Appreciation occurs over months and years, not days and weeks. If you're investing expecting to double your money in 6 months, you're setting yourself up for disappointment and poor decision-making. Realistic expectations for silver might be annualized returns in the mid-teens during favorable environments, with substantial volatility along the way. That's excellent performance for a hard asset, but it's not the get-rich-quick outcome that draws speculative money. Many investors spend all their time planning entry, but give no thought to exit strategy. Without predetermined answers, You'll make emotional decisions in the heat of the moment. Perhaps you exit if physical inventories rebuild substantially. Perhaps you reduce exposure if allocation grows beyond a certain percentage. Perhaps you hold indefinitely as a permanent portfolio allocation. Whatever your approach, decide it now, not during maximum fear or maximum greed. We've examined the mechanics of what's happening in silver markets right now, significant physical withdrawals, major short position covering, and structural stress in the price discovery mechanism. We've placed these developments in historical context and explored the macroeconomic backdrop that makes this moment particularly significant. We've outlined strategic approaches for current holders and potential new investors, emphasizing position sizing, diversification, and emotional discipline. And we've identified the critical mistakes that destroy returns for most precious metals investors. Now let's bring this together with final perspective. If silver's trajectory were guaranteed, there would be no returns available. Everyone would already own it, and prices would reflect the certainty. Your job isn't to eliminate risk. It's to understand it, quantify it, and take positions sized appropriately to your personal circumstance from now. You need to understand the forces at work and position yourself sensibly to benefit if those forces play out as expected. Preparation means having a strategic framework, knowing your position size, understanding your risk tolerance, having predetermined decision rules for various scenarios. Prepared investors capture opportunities. Unprepared investors react emotionally and suffer accordingly. Global debt continues growing. Central banks continue expanding money supply. Geopolitical tensions remain elevated. Industrial silver demand continues its structural increase driven by technology and energy transition. Supply remains constrained by geological and economic realities. They suggest that precious metals, including silver, have a role to play in portfolios for the foreseeable future. Successful investing isn't primarily about finding the best assets. Can you hold positions when everyone around you is panicking? These skills matter more than your ability to analyze supply-demand fundamentals. It's not your entire strategy. It's not the only asset worth considering. It's not a magic solution to all financial challenges. Maintain your emergency fund, contribute to retirement accounts, invest across asset classes, control spending, increase income, reduce debt. But within a balanced approach, silver can serve valuable functions: portfolio diversification, inflation protection, crisis insurance, and potential appreciation during specific market environments. No one knows with certainty how current market dynamics will resolve. Perhaps new supply emerges or industrial demand softens, allowing markets to rebalance at current price levels. Perhaps entirely unexpected factors dominate the next 12 months. What you can control is your level of preparation, your position sizing, your emotional discipline, and your strategic framework. If you're a current silver holder, review your position size, storage arrangements, and exit framework. Ensure you're comfortable with your exposure level. Ensure you understand why you own what you own. Recommit to holding through volatility if your thesis remains intact. Do additional research. Determine an appropriate allocation for your specific circumstances. Develop an entry plan, whether that's a single purchase or a scaled approach over time. But make these decisions from a place of clarity and calm, not from fear of missing out. The post-2008 era of unlimited central bank intervention, the pandemic era fiscal and monetary expansion, the current inflation dynamics and geopolitical realignment. These forces create both risks and opportunities across all asset classes. Not the only response, not necessarily the best response for everyone. The 25 million ounces that have left the physical silver market represent real metal, withdrawn by real market participants, making real decisions about value and risk. The unwinding short positions represent institutional players reassessing their exposure in light of changing market conditions. What they mean for future prices depends on countless variables, many of which cannot be predicted in advance, but they suggest heightened attention is warranted. Strategic thinking is required. Emotional discipline is essential. Approach the current environment with clear eyes, solid preparation, and appropriate humility. Build positions sized for your circumstances. Maintain discipline through volatility. Focus on long-term fundamentals rather than short-term price movements. And remember that successful investing is ultimately about making sound decisions consistently over time, not about making perfect predictions about unpredictable futures. The opportunity is real. The risks are real. Your response should be measured, strategic, and grounded in your personal financial situation. That's how you build lasting wealth, regardless of what happens next in silver or any other market.